Have you ever sat down for your trading session, London or New York, you go through your first round of analysis and you end up being confused? Everything seems unpredictable, things seem random, and you're not sure what you should be looking at anymore. But the truth is, there's underlying structures that repeat themselves. There's processes that we can learn. There's knowledge that we can gain to exploit these opportunities and take advantage of high probability trading conditions. Let me show you a common mistake that I see with most traders. We're on the daily chart on EU. We have high prices, we have low prices, and this is what has been presented to us. We can see here we've got January 2024. This is when the new year started. So straight away, we can see that when we got to the middle of January, we entered the middle of the range. So often I see people trading in these locations. They're making poor decisions. They're looking for price to extend in the middle of the range. I see traders putting all of their efforts into these locations on a chart. This is what leads to frustrations. This can become overwhelming, and ultimately it's hard to see the bigger picture. And that's where RIMC comes in: range, initiation, mitigation, continuation. It's a simple yet powerful framework that helps you identify the three main phases the market can present. By understanding these phases, you can filter out the poor decisions, the poor locations, and focus on high probability trades. Back on our chart, we can understand that we're observing a range. We can see that price has initiated away. Price is then returning into that sideways range for a point of mitigation, and then we can take that mitigation for continuation into lower prices. And that's the power of range, initiation, mitigation, continuation. In the next few minutes, I'm going to break down each stage of RIMC in detail. We're going to look at real life examples, and I'm going to show you exactly how to apply this framework to your own trading. Be sure to stick around, and if you want to take your trading to the next level, then you need to watch this to the end of the video. So what is a range? A range is contained price delivery. Over time, we will see that price is contained between two price levels. What we end up seeing is price has not moved above its high or above its low within that time frame. This we can start to identify as sideways delivery. This is probably one of the easiest things to notice on our charts. It's absolutely everywhere, and we can identify this by looking at the same characteristics with price remaining between two price levels. So that will be a high price and a low price. And when price is being contained, there's large orders that are being created in the market. This is the basis of our strategy. This is what range means. And we know that when price leaves this range into its next phase, we can start to understand the intention of the market. So ranges is something that we want to have in our playbooks. We want to have in our trading plan, because they are going to give us the understanding on what could happen next. So once we've identified this, we've essentially now got a chance to be a part of the correct intention. And we know that's either going to be for higher prices or lower prices. When it does come to a range, what we're doing here is identifying sideways delivery. And this information is fractal, meaning that we can go to any of our timeframes up here and we can observe the same behavior in price. So now you know how to identify ranges and what ranges mean. We can now start to think about that next phase, which is initiation. Typically with initiation structure, what we're going to see is price moving in one direction. It's either going to be bullish or it's going to be bearish, and that move is going to be quite obvious to us. It's going to be a fast move in one direction, and as we start seeing price move away, we're going to see large candles being formed. Those candles would have high close, and it will get a continuation of high closes in this move. And then we can identify this as initiation. Now, what do we know about initiations? This is where intention is put into the market and we get shown a direction, and that intention will sustain price in one direction, and then we can continue to observe that price behavior. Now, one thing I enjoy about this way of trading is that it becomes super simple to identify what we need to make good decisions. Essentially, what we're observing here is two phases of the market. Price is either going to be ranging between two price levels, and that contain price we can identify, or price is going to be moving above its previous high, continuously printing in one direction. So now you know how to identify these two phases of range and initiation. I want to show you some live examples of how this information could have helped us. Before we jump onto the chart to look at these live examples, we also need to talk about mitigation and continuation, so we can complete the full phase of understanding what RIMC means and how it can transform your trading. Mitigation is the most important phase of this understanding because it's where we build our narrative, being able to catch the correct direction. And if you're a smart trader, you will also realize within this phase that we can trade in both directions. We can trade the move back into the range and we can trade the mitigation away. What am I talking about here? In the phase of mitigation, we anticipate price to pull back into its previous range that we've already identified. So that would be price start to pull back into this location. And we can call this phase of mitigation. What we anticipate from here is that mitigation in price is going to move higher. Why do we believe this? Because the previous move that was shown was bullish, and we anticipate that the mitigation in this location will go on and head in the opposite direction. So if market has been moving down, we now understand the market to be moving up. These become our observations. So that point of mitigation becomes very important. And what we can do here is use a repeatable process to understand and follow this intention in price. Now we covered that phase of mitigation. The best part of this whole process, when we're able to see if we are on the correct side or we're not on the correct side, is that phase of continuation. We can anticipate that continuation will move up into higher prices. That would be confirmed by price taking out its previous high and continuing in that bullish direction. And we get that phase of continuation into higher prices. Now, if we can notice, it's here where we're making our decisions. We're not making our decisions in the middle of the range. We're making our decisions at the point of mitigation. It's so important that we consistently make our decisions around these locations. This is what makes our IMC repeatable. And if we then can apply this into our session, we can start to make consistent decisions over time. It's those consistent decisions that will lead to your profitability and will transform your trading, and you won't approach your session struggling to understand what you should and shouldn't do. Actually, you're going to approach your session using a repeatable mechanical process where you are making the same decisions at the same locations, and that is point of mitigation. If we can identify that we have mitigated something, we can also look to trade the continuation of that move to the upside. So a lot of the times when you see our traders in trades, they're either going to be a part of that continuation leg, they're going to be a part of that mitigation, and that's either selling into that mitigation or buying at that mitigation. And these phases here, typically we are waiting to be shown the market intention. So rather than trading in poor locations in the middle of price, where we're going to consistently see mistakes being made, what we're doing is waiting for that intention to show itself and then playing in the right direction. So one of the beauties of using our repeatable processes is that they are fractal. They work on the 1 minute and they work on the daily. So let's take a look at some examples here. Start from this high in terms of observation. We can see that it's a clear phase of initiation down that we can identify. And then we can also see that right here, we do have that sideways range delivery. So if we just put that on, we can identify that as a range. That's a fact in the market. And we can see that the range has completed itself by moving in the bearish direction, meaning that this location, when it's moved back into, becomes a point of mitigation that we can look to take sell positions at. At least we can do is observe price in these locations and look for opportunities in the opposite direction. So going back into our previous high in the market to the previous low in the market being created, price then pulled back into this location. And if we look here, continuation would mean market moving below this low, and a mitigation would mean a reaction in the opposite direction. And if we're looking for where that mitigation might happen, we'll be looking at a previous range in the market. So before price even got here, we was understood that this is a point of mitigation and we can see price move in the opposite direction. So it's at this location that we start to become observers for a reversal in price. We're not just picking reversals anywhere, we're looking at those points of mitigation. And of course, if this is a mitigation, then we would see price move below its previous low for that continuation in price, that moves down where we can look to be in the correct intention in price. Just wanted to jump in here, guys, and remind you about our community where we focus on range initiation, mitigation, continuation, and there's over 100 traders trading the same strategy using the same pair. Join our community and now they no longer struggle. This information will transform your trading if you just give yourself the opportunity. So just looking at that, we can see that mitigation created lower prices. So let me show you something else in here as well, how this information is fractal. What do we see here? We see a move up in one direction. You can see that clearly from a previous range here. In the market, we can see market moving sideways. So let's identify that as a range. And we can see price then is moving away into this mitigation. If we continue to observe ranges, we can identify here, once again, that we do have a sideways range. And we see price does then initiate out the range shown here, and we're coming back in for that point of mitigation. This was another opportunity at this time in March that was looking for a continuation in lower prices. So here's a few examples now that we can be a part of. These are representations of where we make decisions and where we utilize our repeatable mechanical process to be on the correct side. If we can identify ranges, it means we can identify initiations. If we can identify range initiation, it means we've identified a point of mitigation. And if we can identify a point of mitigation, we've just found the opportunity in price. Now remember, this information is fractal, meaning that we can utilize it on any time frame. Let me show you how I used it on a 1 minute chart to find some winning trades in my session. Now we will be talking about this from a hindsight perspective because I want to move quickly through this video, but purely this is to show you the opportunities that we can capture in our session. If you do want to see more trades and see more details about what I'm going through in my session, have a look at the previous video, episode 1. But right now, we're just going to focus on the observations of ranges and initiations, so then we can start to look at mitigations for opportunities. My London session starts at 8 o'clock. So when I did approach my session, I could clearly see that we was at a previous range in the market. How do we know we're in a range? Because we can see that prices contain sideways. And then what do we notice? Price then goes and initiates outside of that range. So this has given us that direction overall. And now what we can start to look for is mitigation, continuations in that direction, being able to see price open at a previous high. This is my 1 minute entry process to be in this trade. Ultimate precision here, part of my entry process. This does tend to happen a lot of the time, understanding the intention in price. And straight away, we see that we do have previous lows to aim for. We would be looking at the low to be taken for a continuation, and that low does get taken. If you notice that the phase of the market here is initiation phase, once again confirming that this would be a continuation in the market. We actually do see later on in the session, price ranges here. We can identify this range here with this blue box, price mitigates, and then we see a continue in that direction. And we see once again, price comes up to this location, and we're seeing a further move to the downside. That was an opportunity in New York to be a part of that intention. Look at our session, right? We're in higher prices. We can see that higher time frame range that moves away, and all we're doing is continuing to play that bearish direction. If I was to zoom out here, and I encourage you to go and look, we're actually part of a larger mitigation, and we can then see that continuation take a higher time frame low, and we see that the lower time frame here is just following that narrative, and we've been able to identify and execute trades at a point of mitigation. This is 100% our process, and this is how we want to be trading every day in our sessions. Let me take you through the next opportunity. For this one, we are going to go back down on a lower time frame because it's not as obvious. Here is another variation of our opportunities. We can see here that we did have a sideways range be presented to us. Price did then initiate away. What we can identify with this move away right here. Price then started to slow down, and we can see that phase of mitigation here. And then we see the phase of continuation to the upside. If we can see here, that was just before my session, so I wasn't able to be a part of that mitigation. But that's definitely something that I would look for. You know, we can see here quite easily be able to get into that trade, stop below the low, point of mitigation. That's a 2.7 pip stop. You know, absolutely huge RR to be gained on this trade. I wasn't able to capture that trade because it was before my session. So I actually went on to play a lower time frame sideways range shown here. And this is one of the entry techniques that we use, a full bodied OB. And we can see price leaves that range, moves back into it. We get that mitigation, and then price leaves away. And my entry was on that point of mitigation. And this is again a lower time frame opportunity being shown to us using the same mechanical processes. And that trade went on to hit full TP for 10R and was a lovely day for that reversal in the market. And if we actually zoom out here, I wasn't going to show you this, but I will zoom out. and we will scroll back. What you will see here is a previous range in the market where we was contained sideways. And if we drag this left, you'll also see that this is another point of mitigation where we can start to look for the opposite intention. Those keen-eyed traders, you'll start to see here, that move doesn't come in Asia, that move comes in London session. This is why we focus on London sessions, and this is why we like to be a part of those higher probability moves in these times, because we know they can present themselves following range initiation, mitigation, continuation. That's the end of the video. Like I said, if you do want to see more of this, go back and watch my previous video. Definitely have a look at our website so you can understand more about what we do, and I'll catch you on the next one.